Before we enter this conversation, it's important to understand the world that created it. In every major financial crisis, the same pattern repeats. Corporations take the risk, and when the bill comes due, it is the American people who pay the price. In 2008, the largest financial institutions in the country were bailed out with taxpayer dollars, while families lost their homes, their savings, and their stability. We were told the system had to be saved, but only the top of the system was rescued. What followed after the 2008 great financial crisis were suppressed wages, vanished retirement accounts, and a slow, grinding inflation that hollowed out the middle class. And then inflation didn't happen by accident. It was the downstream cost of trillions of dollars injected into failing institutions while ordinary citizens were left to absorb the shock. This conversation in the senior about the witness reflects the truth behind every market crash, every emergency meeting, every so-called financial solution. There is a quiet acknowledgement that the consequences will never fall on the boardroom. They fall on the public. So as you listen to these characters debate risk, loss, and survival, remember this. When the system breaks, those at the top find a way out. But the middle class, the workers, the savers, the families, they're the ones who bear the inflation, the layoffs, the debt, and the uncertainty. This is not just a scene about money. It is a reflection of how economic power protects itself and how everyone else pays the price. Yep.
Well, please sit. Congratulations are clearly in order.
They did the best they could.
You did a hell of a job, and I thank you for it. Come on, sit. Excuse me for eating, but it's been a long day. Can I get you something?
No, nothing, thanks.
So, what can I do for you?
I want out. I'm done. I want out.
It's been a very difficult day.
I need you to release my options. If they're worth anything after today, I want my bonus. I'm out.
You'll get your bonus, your options, and keep your current base, but I need you to stay with me for the next 24 months, okay? Oh, come on, son. Put a smile on your face. You did some good today. You said that yourself. Do you know, I'm starting to feel a little better about this whole thing. You're one of the luckiest guys in the world, Sam. Could have been digging ditches all these years.
That's true. And if I had, at least there'd be some holes in the ground to show for it. I just don't know how we f this up quite so much.
When did you start feeling so sorry to yourself? It's unbearable. What? So you think we might have put a few people out of business today? It's all for naught. But you've been doing that every day for almost 40 years, Sam. And if this is all for naught, then so is everything out there. It's just money. It's made up. Pieces of paper with pictures on it so we don't have to kill each other just to get something to eat. It's not wrong. And it's certainly no different today than it's ever been. 1637, 1797, 1819, 37, 57, 84, 1901, 07, 29, 1937, 1974, 1987. Jesus, didn't that fuck me up good? 92, 97, 2000, and whatever we want to call this. It's all just the same thing over and over. We can't help ourselves. And you and I can't control it or stop it or even slow it. We even ever so slightly alter it. We just react. And we make a lot of money if we get it right. And we get left by the side of the road if we get it wrong. And there have always been and there always will be the same percentage of winners and losers, happy fucks and sad sacks, fat cats and starving dogs in this world. Yeah. There may be more of us today than there's ever been, but the percentages, they stay exactly the same.
When he says the money isn't real, he's exposing the truth most people never hear out loud. Our financial system is held together not by actual value, but by confidence, leverage, and the belief that numbers on the screen represent something solid. Corporations know this, and they exploit it. That's why every major financial crisis becomes another opportunity for the biggest players to profit. They take reckless risks, inflate bubbles, and when everything collapses, they get bailed out with taxpayer money, while ordinary Americans are left to absorb the fallout through lost jobs, wiped out savings, and skyrocketing inflation. The middle class pays the price so the system can reset and the cycle of greed can continue. The money may not be real, but the suffering, the inequality, and the consequences always are.
Republican senators on Monday blocked an attempt by Democrats to pass a debt limit increase. Government funding is set to run out on Friday of this week. Janet Yellen says there's only a short window after that before the US would be unable to repay its debts.
Our current estimate is that Treasury will likely exhaust its extraordinary measures by October 18th. At that point, we expect Treasury would be left with very limited resources that would be depleted quickly. America would default for the first time in history. The full faith and credit of the United States would be impaired, and our country would likely face a financial crisis and economic recession as a result. Let me be clear. The government's recent actions have demonstrated our resolute commitment to take the necessary steps to ensure that depositors' savings and the banking system remain safe.
What Janet Yellen described several years ago was the consequences that the U.S. would eventually have to face from years of low interest rates and the Fed's printing an exorbitant amount of money to start off a recession and bail out corporations that are too big to fail during financial insolvency. So let's look at the impact of what happened 17 years ago and how it has led to economic instability.
Reserves regime has proven highly effective, delivering good control of our policy rate across a wide range of challenging economic conditions, while promoting financial stability and supporting a resilient payment system. In this framework, an ample supply of reserves ensures adequate liquidity in the banking system, and control of our policy rate is achieved through the setting of our administered rates, interest on reserve balances, and the overnight repurchase rate. Our long-stated plan is to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserves conditions. We may approach that point in coming months, and we are closely monitoring a wide range of indicators to inform this decision. Normalizing the size of our balance sheet does not mean going back to the balance sheet we had before the pandemic. In the longer run, the size of our balance sheet is determined by the public's demand for our liabilities rather than by our pandemic-related asset purchases.
Quantitative tightening is when the Fed removes money from the financial system. It's supposed to fight inflation, but the economy has weakened so much that the Fed cannot keep pulling money out without risking something breaking. The government is issuing record levels of debt, banks are tightening lending, corporate layoffs are rising, and consumers are slowing down. Ending the quantitative tightening is the Fed quietly stepping in to keep the system from running out of liquidity. The Fed is admitting the economy is too fragile for more tightening. This is a warning signal, not a sign of strength.
Rising prices strengthen economic growth and upgrade defense and diplomatic capabilities. Prime Minister Takaichi Sanae told reporters that her cabinet approved comprehensive economic measures to realize a strong economy.
With this economic stimulus package, the government will prioritize quickly delivering measures against rising prices. We will also fund crisis management and growth initiatives. The government will implement strategic fiscal stimulus to protect people's lives and create a strong economy.
The economic stimulus package is worth about 21.3 trillion yen, or roughly $135 billion. The expenditure from the general account is larger than that of the economic package compiled last fiscal year.
Japan must choose to raise money internally or sell U.S. treasuries to fund their spending. If Japan sells U.S. debt holdings, this results in higher U.S. treasury yields, higher U.S. government borrowing costs, and pressure on the American dollar. When governments start to inject enormous amounts of stimulus money, it usually is a signal that their economy is slowing, their consumers are struggling, and their financial system is under pressure. Japan moves implies global demand is falling, and the U.S. is part of this slowdown. Stimulus is a symptom of weakness and not strength.
For many Japanese, the focus is on what the package will do to tackle rising prices, a pain point for consumers. The Internal Affairs Ministry says consumer price index excluding fresh food was up 3% in October from a year earlier. It touched the 3% mark for the first time since July. The higher cost of food played a key role. Prices excluding perishables rose 7.2% from the same month last year. Coffee beans, chocolate, and eggs saw big jumps. Rice has also remained expensive, rising 40% year on year. Shoppers on the streets we spoke to welcome the new steps to tackle inflation, but many still have concerns. One of the measures in the package is a one-time cash handout plan for parents, about $130 per child.
What Japan stimulates, while the U.S. ends quantitative tightening, the message is clear. Major economies are preparing for a synchronized slowdown. Japan's stimulus, plus the U.S. stepping away from tightening, equals global liquidity injections just to keep the system stable. Japan is dealing with raising import costs and the weakening yen. America is dealing with high inflation, rising unemployment, slowing spending, and weakening corporate profits. Japan injecting $316 billion is a preview of what the U.S. may need to do if economic conditions worsen. If Japan is spending hundreds of billions, the U.S. may eventually have to spend trillions.
But when we talk about back home, experts tell NDTV that look, there are three key reasons why silver really is outpacing gold at the moment. First, of course, is festive and consumption demand that has led to the price surge, essentially, is what experts believe. But more importantly, interestingly, silver is also high in demand at the moment for industrial usage. So that really is the second key reason. And third, and most interestingly, really, is if you're looking to diversify from gold at the moment because of the uncertainty and the price concerns, people are then turning to silver. So silver, of course, being more precious than gold at the moment and clearly outpacing the bullion.
Just this past March, gold traded above $3,000 for the very first time ever. So it's gone up quickly.
Yeah, and it usually goes up when people are worried about the future of the economy.
Yes, and you feel that uncertainty throughout the world right now, throughout economies all over. Investors tend to see gold as a safe place to store money during those times of uncertainty. Gold has doubled in the last 2 years, reflecting the scale of unknowns that continue to hang over major economies, including ours. You have the government shutdown, inflation, the amount of debt that we've taken on with no real solutions to pay it off, lower interest rates, and then that great political uncertainty. You can really think of gold like a financial security blanket.
Gold and silver just broke out of a consolidation phase with a powerful rally. Investors are considering safe havens and inflation-hedged assets like gold and silver as a bet on economic instability and weakening faith in traditional dollar-based assets. Rising gold and silver prices often reflect growing concern about inflation, currency devaluation, or systematic risk. When investors rush to precious metals, it's often because they expect trouble ahead in markets, in currencies, or in government debt. This breakout isn't just short-term panic. Many analysts believe it's the start of a broader shift in how capital is allocated, away from equities and bonds towards alternative stores of value.
Moody's has lowered the United States credit rating because of an increase of government debt. Let's get right now to NBC's Christine Romans, who covers business. Christine, what can you tell us, and how significant might this be?
Yeah, lowering it by one notch. And here's the problem. The problem is the amount of debt the United States holds and the deficits that the U.S. government consistently runs. And Moody's saying over the past decade, this situation has gotten worse. And in fact, the ability to pay interest on that debt is a real problem. Forecasting that you'll see what's called a debt to GDP ratio of something like 134%. That's bad. These are big debt numbers. So really kind of a warning saying that other countries of the United States' size and financial stability do not have this kind of a debt, but noting that the United States is still the most sought after place to invest money, and to, the Treasury Department to Treasury bonds still the most sought after investment in the world. So it's sort of like going from an A+ to an A, I think, with the warning that things could get worse down the road if Congress doesn't take this seriously.
The credit worthiness of the U.S. government itself is under attack. The U.S. sovereign credit rating dropped from AA to AA-, citing persistent physical deterioration and weakening government standards. In real time, it's like a person going from excellent credit to good credit. The U.S. is still considered credit worthy, but no longer pristine.
Really, investors really watch this very closely because it's a warning. When you have so much debt, like the amount of debt the United States has, at some point, if you're paying so much interest on that debt, it crowds out what you can spend on other things, like social programs, like education. Now, it is, I think, something that's timely because you have the House right now arguing, really divided over the president's so-called big, beautiful bill to run the government and to run, for spending and taxes. So it just comes at a time when this is definitely up for discussion.
When a national credit rating drops, the cost of borrowing for the government, but also for businesses and consumers, tend to rise. Higher borrowing costs can translate to higher mortgage rates, more expensive car loans, tighter credit overall.
We're going to get to the GOP in literally 30 seconds, but give us the impact on the consumer. How is the consumer going to feel, if at all, this Moody's downgrade?
I don't think consumers will feel this overnight, but we do know, we saw the University of Michigan consumer sentiment number today that did show consumers are already feeling pretty sour. They're worried about inflation. That's what they're concerned about. They're worried about tariffs. That's what they're very concerned about. This was the second lowest number in history for the consumer sentiment number. So it shows you that the American consumer right now, less concerned about a pie in the sky Moody's kind of downgrade, more concerned about their own bottom line at the moment.
Consumer and retail may not feel this policy shift as of now. However, this downgrade reflects deeper problems in the American economy, which is persistent high deficits, raising interest payments on debt, and a political environment that seems unable to stabilize. This physical instability will eventually seep outward, affecting everything from mortgages to investment portfolios. This is a warning signal for you to hedge your bets against inflation. Expect your mortgage rates, car loan APRs, and credit card APRs to increase, and your retirement portfolio and 401k to be threatened by this high inflation.
For those who are looking to buy a new home. As of November 15th, mortgage giant Fannie Mae has scrapped its minimum credit score requirement of 620. Now, this move could potentially allow more Americans to qualify for loans from lenders who review borrower information through their current underwriting systems. This expansion also gives new opportunities to borrowers with so-called thin credit files or non-traditional credit histories.
With Fannie Mae dropping their minimum FICO credit score requirement for certain mortgages, this means buyers who previously would have been considered too risky with lower credit scores or thinner credit histories can now more easily qualify for a home. In other words, what used to be a credit qualifier filter is now gone. Lenders now have more discretion in issuing mortgages.
This is pretty big news for those who have always dreamed of being a homeowner but just misqualifying through Fannie Mae. What is changing here? What does this mean for so many consumers out there?
Well, you're absolutely right. This is a big deal because a floor has been removed. So it used to be sort of an up or down vote.
You're in or you're out, 620, that is it. The difference here is now they're going to take a more holistic approach, and that's going to be more inclusive, as you mentioned, to people who maybe have a thin credit file, who maybe wouldn't qualify with just the hard stop at 620. Now they're going to look at other factors. They might have to have a larger down payment. They might have to have more cash reserves. It's not necessarily, this is important though, it's not necessarily a change in the underwriting standards. You still have to be a good risk for the lenders.
Lowering the credit bar for mortgages can lead to a surge in higher risk loans being issued, similar to what happened in 2008, leading up to the past housing crisis. If economic conditions worsen, say due to rising interest rates, inflation, or job losses, many of these riskier borrowers might default, putting downward pressure on home prices, increasing foreclosures, and destabilizing lenders. If this happens, expect the banks to be stressed, a weaker fiscal stability, rising borrowing costs, and a wave of defaults that could ripple across the financial system, which may accelerate an economic downturn.
The purpose of a longer-term fixed-rate mortgage would be to lower the monthly payment for homeowners. The longer the term of the loan, the smaller the principal needed each month to pay it off in full. Using the latest median sale price of a home from September, $415,200, according to the realtors, and the current interest rate of about 6.3%, according to Mortgage News Daily. On a 30-year fixed loan with a 20% down payment, the monthly payment of just principal and interest would be $2,056. Now, if you raise the length to 50 years at the same interest rate, that payment would be $1,823, and that's a savings of $233 a month.
Even though this idea is being promoted as a way to make homes more affordable by lowering monthly payments, the math tells a very different story. It dramatically increases it. A standard 30-year mortgage on a typical home can already cost over $440,000 in interest over the life of the loan. But when you stretch the loan to 50 years, the interest burden explodes, meaning borrowers end up paying hundreds of thousands more while building equity at a snail's pace.
Homeowners, however, wouldn't build equity as quickly, and that's because their principal payments would be smaller, and the amount of interest that they're paying to lenders would actually be 40% higher. Homeowners could still gain equity through home price appreciation, but home prices have been softening swiftly across the nation this year, with nowhere near the appreciation seen in the years before. Now, even realtors agree that the savings to homeowners would be minimal. Joel Berner, a senior economist at Realtor.com, said in a release, "This is not the best way to solve housing affordability. The administration would do better to reverse tariff-induced inflation, which is keeping the rates on existing mortgages high."
In fact, even after 10 years of payments on a 50-year mortgage, you barely chipped away at the principal. You're essentially just renting from the bank for a decade, except with all the responsibilities of ownership.
Then there's the question of what's the mortgage rate? The average rate on the 15-year fixed mortgage is currently 66 basis points lower than the rate on the 30-year fixed. So this would kind of imply that the rate on the 50-year fixed would be higher. It all depends on investor demand for the product, of course. I spoke with Matthew Graham at Mortgage News Daily. He told me there is not currently a secondary market for these loans, nor would a robust secondary market be cultivated anytime soon. That means that in addition to the extremely low amount of principal paid down in earlier years of the loan, the interest rates would also be quite a bit higher than 30-year loans. He calls that a double whammy for those with any hope of building home equity.
Historically, countries turn to a 40 or 50-year mortgage when housing prices become completely detached from incomes. That's not a solution. That's a symptom of a bubble. So when you see policymakers proposing 50-year mortgages, it's not relief, it's a red flag, a sign that the housing market is being stretched beyond sustainability, and households are being pushed deeper into decades-long debt just to keep the system afloat. The warning signs are everywhere, from Washington's debt problems to shaky underwriting standards, to financial system stress, to asset price shifts. We might still have time, but the moment to pay attention is now, because once trust in credit, housing, and finance erode, things can unravel fast. But here's the question I want to leave you with. If the status quo begins to crack, where will you put your money? Not in risky mortgages, not in unsustainable credit bubbles, not in paper promises. What about real assets? Land, hard assets, precious metals, maybe even alternative investments like art or, if you're bold enough, NFTs and crypto. Stay alert, stay ready, because the next few years may determine the rest of your life. Peace.